Hi, and welcome once again to another session in the topic area of quantitative methods in your CFA Level 1 curriculum. Today, we're going to talk about the part 2 of our presentation about the reading on time value of finance. Of course, in the first part, I talked about the integral relationship between the time value of money, time and the money, the relationship being intricate and eternal, and how the discounted cash flow model and the time value of money can be used as a tool to value different securities. In fact, 90, or I would say, majority of the securities that trade in the market which has a future cash flow embedded in it, or the capital appreciation could be enumerated in one way or another. Of course, discounting is one of the primary ways and the most logical ways, and I would say the most intuitive, fundamental ways are actually valuing the security on present day. And from there, of course, we also boiled it down to different application of the time value method, not only limited to calculating the value, but in fact, gleaning through the concepts of implied growth, the required rate of return, the likely dividend, that is like the likely dividend in the future foreseeable period, and so on and so forth. In particular, we also disclaimed that the entire presentation of ours is going to be based on the use of the TIBA2 plus calculator. To this extent, I'm of course biased because I firmly believe that over 95% of the candidates, they do actually use this approved calculator, although there is one more in the fray. So I also thought that, I would exploit and utilize this opportunity to impart most of the lectures of mine rather than me being verbose and walking you through labyrinth of formulas and shoving them down. It's better that I solve the problems in practicality and show you the ways of actually making use of your calculator, because that's not only going to help you in your actual exam, but will also help you understand faster the underlying concept. Nothing like actually getting into the think and tiddle and solving your problems, rather than simply beating around the bush with some silly formulas or silly theories. All right, so from there, we started valuing the security, starting with the zero coupon bond to the mortgage cash flows, very important aspect. I spent over half an hour only on this particular problem, not only to make you understand how the level payment is to be calculated, that's a few seconds job, but more importantly, how the amortization schedule is actually built up and how the amortization schedule can actually be built up in your calculator as well. Also, I told about that from the initial payments of initial level payments, majority of which actually goes into servicing the outstanding debt in the form of interest, how it actually shifts, wherein at the later half and as we approach the maturity of the loan outstanding, the lease outstanding, the debt outstanding, how the level payments majority portion actually goes into retiring the debt, and only the leftover is there to service the debt as part of the interest. So from there, we started learning about annuity. I distinguished between annuity, ordinary annuity, and that of annuity due. And I believe that I also walked you through a specific example using three different methodologies to calculate the future value of an annuity due. And I told you also that how this particular formula and this particular expression is actually the best one to utilize in order to find out the annuity due. All right. So from there, the rest of the things are all about uh, navigating through different uh, interest rate regime, different periodicity, and dividend growth rates, constant dividend discount models with in perpetuity growth or tapering to a specific value. We walked through those examples, and I believe that if you follow through them, then majority of not only concepts related to quants will be cleared, but also majority of the equity. It's going to give you a little bit of a peekaboo, little be a bit of a forward, a preface to what to expect when you study the equity portion as well. So, all right. And also, I fleetingly discussed about the fundamental distinction between that of the equity and equity-like instruments and that of the fixed income securities. Do remember, majority of, except for the derivatives, of course, majority of the financial securities or the assets that you will be dealing with, they're one way or the other, they're going to either fall into the bucket of either fixed income or fixed income like securities or equity like instruments. All right. So we took up the specific example of a company. We took the example of how, with a limited growth period for a limited horizon, how to value that particular company, and if it is in perpetuity, how to value that. We made use of the infinite geometric series progression, and then we utilized those concepts, those formulas in order to value the growth in perpetuity as well. And this is what it actually comes out as part of the as part of the securities value. It is very similar to when you're getting a certain amount of payment in absolute term. When you put that money into bank, you basically, what you do is you divide the absolute amount by the interest portion to know what is the required amount that you'll have to keep into the savings account or the interest bearing account. This formula is exactly similar to the same. Just think of this denominator as K minus G, or sometimes also known as R minus G, as the net interest or net cost. Just remember that this is net interest or net cost. If you liken this, and if I put this as R, then the rest of the thing is exactly identical to what we have done in case of finding out the amount in a fixed income security. Nothing great about it, right? And then the rest of the problems are just about algebraic transposition. As showed you that how out of the 4 variables, if 3 are given, how the 4th one can be found out. So from here also, I need to again fall back upon some of the concepts of dividend itself. You see, when we talk about a dividend is a constituent of something known as the earnings. It's for sure not very hard to understand that a company is going to, going to partake some portion of its earning, some portion of its earning with the common shareholders, with the existing shareholders. And that is going to come in the form of a cash outflow from the company's perspective. And we call this portion as the dividend. Okay, so dividend is nothing alien. A dividend is not something that has fallen off the sky. It's basically part of the earning itself, which is distributed to the common shareholder. All right, so that means that we could also express any dividend as something known as the payout ratio. What is a payout ratio? Well, it's simple. If, let's say, the earnings for a given company in a given year, and let's just boil it down to earnings per share basis. Let's say the earnings per share basis happens to be $10. And out of this $10, if the company decides that it wants to pay out, let's say, $2 as part of the dividend, then of course the payout ratio happens to be 20%. I believe that it's a no-brainer to any one of you having the basic understandings of mathematics, right? So that's what is known as the payout ratio. Now, a little bit of algebraic manipulation out here, as you would understand that, if P0, and I'm not going to again revisit the same concept because I've already done that. If P0 could indeed be represented as a period ahead dividend being paid in the future divided by the net cost of that dividend, which is represented as the required rate of return for the equity minus the growth rate of dividend, or the growth rate of the company as a proxy, then of course D1 can also be represented as a payout ratio for the for the company. So for example, if we say that the D1 is, let's say, 0.7, okay, so we could substitute this value of E into 0.7, where E happens to be the earnings, as part of the D1. So I could write this as P0 is equal to E1. E1 is the earnings for next period multiplied by 70% or 20%, which denotes the payout ratio. Let's make it 20%, divided by the net cost, which is R minus G. So from here, we can glean out P0 by E1, which is also known as a forward PE, as equal to 0.2 divided by R minus G. Now, this is one of the most powerful and most heavily used expression, especially if you are an equity research analyst. So P by E is known as the forward P. Of course, you would also learn something called as justified P. You would also learn something called as the trailing P, but I'm not going into those differentiation because, again, this is learning related to quant and not in particular about equity. Let's solve a few problems. Consider Tesla included. Consider Tesla with a forward price earning ratio. And here also I must make one point very clear, unless otherwise I specified. Always do always do understand that whenever we are talking about the PE ratio, because most of the people, they do actually confuse. Uh, Whenever we do make mention of the PE ratio, that's always by default a forward PE ratio. This is a forward PE ratio. That means it is P0 by E1. Of course, many a times uh, we discard the sub hyphenation out here, but that's not the correct approach, and we simply fall back upon the general expression of P divided by E. But truth be told, strictly speaking, whenever we are talking about the forward P, wherever we're talking about the P, we are necessarily talking about the forward PE. All right. Okay. So given this, uh, it's being said that Tesla has a forward P of 28 and an expected dividend payout ratio of 70%. An analyst suggests that Tesla should yield a 9% return. They should yield a 9% return, and they anticipate the dividend is going to grow at the rate of 4.5% annually indefinitely. Provide guidance on the investment strategy for an individual looking to invest in a Tesla stock. So what do we have? We have a forward P, P0 by E1 as 28. That's already been given, and an expected dividend payout ratio. So obviously the D1 is going to be 70% of E1. Okay, so this is actually going to be uh, 0.7 into 28, whatever that factor be. This is my D1. All right, and then the G has been given, which is 4.5%. R has been given, which is 9%. The rest of thing is simply plugging those figures. So all that has been said is we need to provide a guidance about the Tesla strategy. So we could solve it in a couple of ways. One is that we could from the given figures from out here, we could find out the justified forward P out here. So the justified forward P is nothing but simply P0 by E1 is equal to your in terms of payout ratio, since it's going to be 0.7 divided by 0.09 minus 0.05, which is equal to 0.05, which happens to be 15.56%. Okay, this is the figure. Now, what does this imply? It implies that given the earning, given the expected dividend for the next period, Tesla should be trading at $15.56 in absolute terms for every dollar of earning. Every dollar of forward earning, Tesla should be priced at 15.56. But what do we see? We see that every stock of Tesla is trading at a dollar absolute value of 28 for every $1 of earning in the future, one period ahead future, which means that the market price is definitely much higher than what it should be when we compare the fundamental values. All right, so this tells us that the Tesla price is overpriced, all other things remaining constant. The idea is that we should not obviously invest in this stock because it is heavily overpriced. All right. So how the equation can further be used in order to glean out the implied rate of return for a growth, we'll work through a few examples. And I have these examples I have directly picked up from your curriculum, and I read out. Coca-Cola Company stock trades has a share price of 63. Annualized expected dividend per share during the next year is 1.76. So we have been given P0 as 63. The annualized dividend for the next period has been given to be 1.76. If analysts expects Coca-Cola's dividends per share to increase as a constant 4% year indefinitely, that is, the growth has been given to be 4% indefinite. Calculate the required rate of expected return. So of course, R is to be found out. And I'm sure that you could do this because P0 happens to be, we have just to put in the silly formula, D1 divided by R minus G. From here, you'll have to isolate that. Again, I actually will be wasting my time working through this example, but fine, let me just work through them as well. So we have D1 has been given as 1.76. Okay, so we're going to put this as 63 is equal to 1.76 R minus 4%. So from here, R can be directly algebraically found out as 6.79%. So this is the required return or the required discount rate or the expression of the riskiness of the Coca-Cola company from the data that has been provided. Now, the next year, the next problem asks, if the analyst believes that the Coca-Cola investor should expect a return of 7%, calculate the implied dividend growth rate for Coca-Cola. So all that is being said is instead of R being 6.79, we have to put in this figure. We have to put in this figure as 7%, and we have to glean out the G from here. So all that we do is 63 is equal to D1 is 1.76. We leave it at that. 0.07 minus G. Of course, G is going to be somewhat greater than 4%, I believe. Still, we could work this out. So these are simple arithmetic, algebraic rather transpositions. So the G happens to be 4.2% if you work it correctly. Okay. The next question asks, suppose Coca-Cola stock trades at a forward price to earning ratio of 28. Expected dividend payout is 70%. Dividend will grow at 4%. Calculate Coca-Cola's required return. So again, what's been stated is 3 given, fourth one is to be found out. 28 is equal to 0.7 divided by R minus 0.04. So from here, we'll have to find out the value of R. Of course, R should be somewhere around. Let's see. Again, it's pretty easy. There's really nothing for me to work through this. Around 6.5%. All right. So how I hope you understand through this simple warning that how from this equation, P0 is equal to D1 divided by R minus G, or you could, instead of D1, where D1 could be expressed as either D0 into 1 plus G, 1 period ahead of growth, or D1 could be directly expressed as the payout ratio. So which means P0 can be expected as E1 into certain percentage. Let's just put this percentage at X%, R minus G. So from, of course, we could understand that out of these 4 variables, if 3 are given, the 4th one can be found out. The next question again suggests that the forward pricing PE ratio has been 28, expected dividend to 70, required return 6.5, G is to be found out. Now, really speaking, I am not quite interested in doing this because you can understand we've already found out the R from here as 6.5. So obviously, it's just the recalibration of the whole equation. And if you calculate the G's value, is going to come out to be 4%. The next question reads, a stock index is trading at the forward earnings price to earning ratio of 19. P0 by E1 is 19. Expected dividend payout ratio is 60%. Expected index return is 8%. Calculate the implied constant growth rate. I am sure that again you could do it yourself. This is again very simple out here. This 8% minus G, you have to calculate the value of G. Again, this is pretty simple. And G happens to be 4.84%. Okay, so from here we now come to the last portion of the particular text. And mind you, when I'm going to talk about this particular LOS, this particular portion of your curriculum, again, it embeds a lot many concepts from the other topic areas as well. Let's understand a few things. Let's say we are talking about, let's say, 3 assets, A1, A2, and A3. Okay. Let's just understand that all these three assets are similar in nature. Or should I say that A1 and A2 are basically part of the same conglomerate. A3 could be part of a separate, it could be a separate company, but A1 and A2 are definitely part of the same conglomerate that's trading in similar business in the trade in the similar business. And let's assume that we are specifically talking about two markets. You could pick up any market. Let me pick up the market in India out here, and let's pick up the US. And both A1 and A2 trade in India as well as in US. If that be so, then in the event that A1 trades at X price in India and Y price in US, or A2 is trading at X2 price in India and Y2 price in US, after adjusting for the exchange rate, if there be any difference that still persists, of course, there are going to be differences. Currency trading is not as easy as it sounds. Of course, there are extraneous costs attached to them. So if we discard those costs, those extraneous costs, those taxes, those margins, dealer margins, and those anything else that we can think of, and we take the pure unadulterated exchange rate, if we adjust for that, if we still do find, after adjusting for the same, if we still do find there be some significant difference or any difference at all, that would give rise to something known as the arbitrage opportunity. So for example, let's say that X1 is trading in A1 is trading in India at, let's say, after adjusting for the exchange rate, I'm expressing in dollar. Let's say it is trading at $10 a piece in India, whereas in US it's trading, let's say, $13 a piece. So after adjusting for the exchange rate, the difference of this $3 obviously can be exploited immediately. How? Because it would, if there are no artificial trade barriers, then obviously investor could buy this cheap in India and then dump the same stocks in US simultaneously. And in the age of information technology, at the age of AI, in the age of uh, a more globalized world, it's just a click of a mouse. In fact, no human need to actually sit in front of the computer. The algos and the AIs are going to do the job for them, and they're going to do the job in bulk. They're not going to trade in a share or two, not even in hundreds and thousands. So much as the limit permits, they would actually exploit the entire limit because it's completely riskless altogether. And the buy and sell button could be pressed on simultaneously, and thus would give rise to something known as the arbitrage profit. Arbitrage is definitely a free lunch. All right. Now, this is uh, uh, one way of actually looking at arbitrage. Along with that, there is something known as the mispricing. We have talked about mispricing quite a few times. Mispricing is, of course, when we intrinsically or fundamentally try and find out through the discounted cash flow method, mostly the discounted cash flow method, the fundamental value of any security. And if we see that the present market value differs significantly from that fundamental value, either on the plus side or on the negative side, that's again going to give us some speculative opportunity and cash in some speculative profits. Simply riding on that mispricing and hoping that somewhere down the line convergence would happen. So this is purely speaking not arbitrage, because the main difference between arbitrage and speculation is that arbitrage, the profits are instantaneously generated and they are absolutely riskless. Whereas in case of spotting mispricing and taking suitable position would require not only investing your capital, maybe levered capital, does not matter, but of course you would have to expect the market to converge and walk the path that you actually anticipate. That may or may not happen, and even if that happens, there is no guarantee that it's going to happen within the time frame of your investment horizon. So that's the difference between mispricing and exploiting the mispricing and that of the arbitrage opportunities. Nevertheless, so far as our content, so far as our curriculum pertaining to the quantitative methods are concerned, we are going to intentionally use the opportunities of arbitrage and mispricing in order to glean out these learnings as well. For example, the forward interest rates, currency exchange, and the option pricing as well. Specifically, I have excluded this portion, although it is contained in your LOS, in your curriculum as part of the quantitative methods in the quants curriculum. But I believe that the option pricing is best understood when we learn derivatives. So in particular, I'm going to exclude this with the disclaimer that they're going to be covered in our derivatives section. So I hope that you pardon me for that. All right. So again, as before, without much ado, let's first try and see through the problem, see the or understand the theory through a given problem. Let's say uh, we are talking about the Fed, and the Fed issues a couple of notes. One is of only a year's duration and is going to carry a yield of 2.5%. And another is going to mature a couple of years down the line, and it gives you 3.5% as yield. Okay, there are no interim coupons. These are all a zero coupon bonds. What is asked is, what is the forward rate 1 year from now for one more year? So let's first understand what is the meaning of spot rate and forward rates. The spot rates are the interest rates that, or the spot exchange rates, or the spot interest rates are the values that are present today. So that means if I have to do the transaction today, the rates that are going to be applicable to me is what is known as the spot rate. It could be for it could be for a delivery of an asset, or it could be for taking out a loan, or even investing in a given security. The rate that is going to be applicable to me is known as the spot rate. All right. Now, as far as the governments are concerned, most of the sovereigns, they do float securities which vary from short term, which is between 0 and 1 year maturity, to medium term, which could be 1 to 3 years maturity, to long term, which could be from 3 to even 5 years maturity, or even extra long time. I mean, CDs that actually range from 5 years to 30 years. So these are known as treasury securities. Now, I am representing all the sovereigns, government securities, G6, as treasury securities. But you could extend this to any sovereign for that matter that has the capacity to issue their security in the market. Now, why do the government will need to issue this security? For simple reason that they will need to borrow money from the government, from the country itself, from the populace itself. And to finance different projects, to fund different operations, not only to run the government, but also to finance different projects, run different welfare programs, and so on and so forth. Basically, to run the government in particular. Now, in this example, we are talking about two such notes being issued by the Fed government. One, as I said, is going to yield 2, and these are discounted notes. So you could simply understand that the fair price of these securities today is going to be, it is going to be 97.5 here, because 97.5, or I mean, 100 is the face value. So if it's 100 is discounted uh, at 2.5% a year down the line, that's going to roughly yield you 97.5. And I did this calculation on the, I just did this calculation on the fray, on the run, because it's that simple, because it's that liquid. There is least amount of ambiguity in these securities, because these securities are the most liquid securities in the market that you can think of. All right, so given this, let's also understand what is meant by forward rates. Now, forward rates are basically those instruments. So we first talked about the spot rates. The spot rates, how many spot rates are there? So yes, you guessed it right. We have spot rates uh, that could range from 1 year to, practically, t is equal to 0, t is equal to 1 out here. 1 year, in fact, there are uh, bills, there are notes, then there are bonds, long-standing instruments that could range The government side, the Fed side, that could range from few months to a year to even 30 years. All right. So these are all spot market instruments that are floated in the market. And by default, the government securities are the most liquid securities in the market. Why is it so? Because you can understand that's very simple. Because the government, at least when it issues currencies in its domestic denomination, is least likely to default. Not that it has not defaulted. In fact, the 1997 Asian crisis or the Russian ruble disaster, they are the prime examples wherein the sovereign may fail on its own domestic currency obligation as well. But those cases are basically rarity. Those are exception, I mean, absolute outliers in the history of financial innovations. Now, so this is what we call is the spot rate. Now, as against that, there are instruments that are also trade in the market. They they are known as forward instruments. Now, the you need to understand that between the first period, that is t is equal to 0 and t is equal to 1, and out here when I say 1, this 1 necessarily does not mean 1 year, but for brevity's sake, we are going to assume that this is one period. So the one period forward rate and the one period in spot rate, they're always going to be identical. There cannot be any difference whatsoever. But however, there are forward rate instruments that also trade in the market, which could be denominated as 1 year forward rate, 1 year from now. And they're exactly denominated in this manner: 1F1. That means 1 year forward rate, 1 year from now. And that means that if you hold this instrument today at a time t is equal to 0, 1 year down the line, they're going to behave as a spot rate instrument and is going to mature in 1 year. Similarly, we could have 2 year forward rates 1 year from now. So that means there are securities in the market that's trading, and they're available right now at t is equal to 0, but they're going to become spot rate 1 year down the line for 2 years period. All right. Now, the $1 million question is that if how many such forward rates can actually we can conceive of? Well, sky's the limit. As with the spot rates, we could have innumerable, infinite forward rates as well. The question is not that. The question is how many of these forward rates are the most liquid, and people do prefer the most liquid forward rates. The reason being that even with the default free securities, there is going to be less requirement of price ambiguity and price discovery when you're dealing with the most liquid securities. So the liquidity premium is obviously going to be the minimal, if not absolutely zero. And as before, the government securities are anyway default free. Now, the idea is that now when we have the notion of the spot interest rates, and also we have the instruments known as the forward rate, and both of them simultaneously trading in the market, you could understand that by design itself, these forward rate instruments are supposed to become spot rate instruments at some point in time in future. And if that be so, then theoretically, this 1 year forward rate instrument 1 year from now cannot differ from the spot interest rate of 2 years today, right? I hope I'm making sense now. We are talking about 1 year forward rate. Let's say we are talking about the spot rate out here first. Let's imagine the spot rates out here. So we have got how many spot rates at time t is equal to 0? Of course, we are going to have two spot rates, two annual spot rates, that is. So which we are going to denote as S1 and we are going to denote as S2. And if we can imagine that we also have a forward rate instrument, 1 year forward rate 1 year from now. So this 1 year forward rate, when we hold here, 1 year down the line, they will become the spot interest rate. So that means that they must converge like this. Okay. Because if they do not, then they are going to again present to you something known as the arbitrage opportunity. Okay. They're going to present to you riskless arbitrage opportunity. Okay. And this is precisely the reason that people not only make use of the forward instruments for their make use of forward instruments to price certain assets, because all the assets at the end of the day are going to have some sort of anchoring to the to the government's interest rate, the sovereign's rate, that is. You could proxy this with the bank's interest rates or bank rate or the treasury yield, whatever you want to get into it. I'm not going to get into the weeds of those classification. Suffice to say that those will form basis as far as pricing any instrument is concerned. Because for pricing, what do we do fundamentally? Yes, we have discussed, and this is the whole chapter is dedicated towards this. We actually discount the future cash flows. And while discounting the future cash flows, we require the discount factor. The discount factor, of course, always resides in the denominator, isn't it? And when we are talking about this discount factor, the discount factor must have its anchoring to those treasury rates, to those risk-free rates. So I hope that this deep learning, this deep understanding, this deep relationship is now well visualized and well understood. So arbitrators, speculators, normal traders, they all not only keep a watch on the spot interest rates or the spot foreign exchange rate or any of the spot rates, but also simultaneously they keep a track of how the forward rate instruments are moving. Because if there be any difference that could actually be enumerated today at time t is equal to 0, then of course that would not only present an arbitrage opportunity, but also it may actually help us understanding that which are the securities that are mispriced and thus can be exploited for the speculative values. All right. So with this now, with this background, and again, I know that I'm transgressing a lot, but because your curriculum actually demands so, because honestly, this portion again should have been actually being taught in your derivatives lesson, in your derivatives books, or in your fixed income books, but they have included this as part of your quantitative methods as well. And so I'm constrained and I'm compelled to take a forward on this as well. All right, so what it states is that we have now got two issues. One is forward rate of 2.5%. And remember, we said that the first year forward rate and spot rate, they're always going to be identical. There cannot be any difference. So we have a couple of securities out here, wherein the first security is going to mature in 2.5%, going to mature 1 year down the line and carries a yield of 2.5%, which means presently it should be valued at 97.5. And the second one is going to mature 2 years down the line at 3.5% yield. What is being asked is that given this, what is the implied forward rate or what is the justified forward rate 1 year from now for 1 year? That means we are asking about the forward instrument that perhaps trading in the same market today as well. Remember, we said that as far as the liquid securities like that of the treasuries are concerned, at any given point in time, you can have the spot interest rate instruments traded in the market. You could also have the forward rate instruments traded in the markets both simultaneously. All right. So given this, let's just work it out. Now, to prevent arbitrage, of course, you can understand that both of them must be priced equal because they are actually coming out from the same stable. In fact, they are identical instruments, but for the tenor out here. So in other words, if I, let's say, invest into a government security, which is going to yield me 2.5%, so that means I can invest into this security. Let's say I invest $1 in this security for the first year forward rate. So it's going to yield me 1 into 1 plus 2.5%. It's going to yield me 2.5%, right? All right. So that's number one. And if I invest into the security number two, this is security number one, of course. And if we invest into the security number two, that's obviously going to yield me 1 plus 3.5%, but it's being compounded for a couple of years because it's going to mature 2 years down the line. Okay. Now, given these two scenarios, how do we actually equate them? Because the tenor differs. Well, there are several ways to compare the securities as before. But the idea out here is not to actually compare and see which one is superior. No, that's not the point. The point out here is we have to find out this particular rate, 1 year forward rate, 1 year from now. 1 year forward rate, 1 year from now. This is the rate that we have to find out. And mind you that this forward instrument is now trading in the market at time t is equal to 0. And they're going to carry those values as we have to find out the forward rates, those rates. So you can understand that if our understanding is correct, this forward rate of 1 year, 1 year from now, uh, by the time we would have actually covered, we would have actually traversed to 1 year. That means at the end of 1 year, this forward rate will automatically or should become the spot interest rate for one more year, effectively. All right. So that means the same security which I had actually invested in, which yielded me 2.5%, at the 2.5% at the end of 1 year is obviously going to give my money back. And I don't know how much it is going to give me. Of course, it's going to give me some 1.025, isn't it? It's going to yield me 1.025. Now, if I take this 1.025 and invest this at one more year, which is essentially then it becomes a spot rate. Now it is the forward rate. Then it should be identical to 1 into 1.3035 square, isn't it? Because if you look at this, there is no way on earth, if this is not the case, there is no way on earth arbitrage could be prevented. And mind you, we are talking about government bonds. Algos, AIs, humans, they can exploit this opportunity to the hilt, and perhaps they could actually, run the treasury completely dry. The coffer may actually run dry if one is not careful. Okay. All that I'm saying is that this equality must hold, which says that in a perfectly free liquid market, if you invest the security for 1 year, earning you 2.5%, and then you encash that security or take that full yield and put this as part of principal for one more year at some forward rate which we are not aware of. So that's how your 2 year investment period is done. So you break the investment for 1 year and then invest it for one more year. That should be identically yielding the same result with the same investor who would have put the money, locked in the money for 2 years at 3.5% treasury. Because if there is any other way, if there is any exception to this, arbitrage will definitely set in. So that being said, from this equality, of course, we can understand, and this is the basis of something also known as the pure expectation theory, by the way. Uh, so that means from this particular equation, we can always find out the 1 year forward rate 1 year from now, 1F1, we can find out, right? Well, I'm sorry. Yeah. So that would mean that 1 year forward rate one year from now can be represented as 1.035 square divided by 1.025. Okay. So if we solve this, we're going to get a value of 1.045. Okay, which tells us the 1 year forward rate from now is going to be 4.5%. Simple. Okay. Now, was this background important? Well, I could have avoided this background, but then mechanically solving this problem, you'd have never gotten the underlying theory. The underlying theory is this thing, and I hate it. I hate it because I'll have to redo this whole exercise when we learn derivative or when we learn the fixed income securities. Uh, Again, I'll have to walk you through the same exercise. But this is the whole and crux of it. Now, an elegant shortcut does exist, which will save you this calculation, and that could be written as 1F1 is equal to R2 T2 minus R1 T1 divided by T2 minus T1. Okay. And all that you need to do is substitute the formula. R2 here happens to be the bigger interest rate, which is 3.5%. So 3.5 into how many years? For 2 years, multiplied by 2, minus the smaller, minus the 1 year interest rate, happens to be 2.5%. So it is 2.5 into 1 divided by 2 minus 1. Okay, T2 minus T1. So if you do that, you're going to directly get the answer as 4.5%. Now, this is an elegant shortcut. Your book nowhere mentions this formula, but this is a very powerful, handy, and yet very simple formula. So if you're ever asked to calculate the forward rate from the given spot rates, you could do that. That's the whole idea. Now, what's the purpose to include this concept in your TVM curriculum? Frankly speaking, if you ask me, I do not know. I really do not know, because to me, it really does not quite make sense. But then again, it's part of your curriculum, so I'm required to actually walk you through this. And what I did was that not only I walked you through the forward rate concept, but also explained the underlying theory as well. The same concept could also be extended to when we talk about the foreign exchange rates. Okay, so I'll again demonstrate how it being used. So let's just take this example. The spot USD INR is trading in the market at 100, which means 1 USD is equal to INR 100. And the 1 year risk free treasury rates in both the US and in India are 4% and 6% respectively. And let us consider the following scenarios. A forex dealer is quoting 1 year forward rate for USD INR at 104. Another one is quoting at 101, and another one is quoting at 101.95, roughly around 102. Now, what's being asked is that analyze the above scenarios, each in isolation, and suggest if any arbitrage is possible. Assume anybody can borrow and lend at the quoted risk-free rates in both countries, and there are no trade barriers or restriction, and capital can easily flow from one country to another. Also assume there are no extraneous costs, taxes, dealer margins, etc. And again, this particular learning, this particular LS should have been exclusively, and mind my word what I'm saying, this should have been exclusively covered in economics, not in your quantitative methods. It has no bearing whatsoever, but for this silly calculation with the quantitative methods. This is an economics concept which we are studying, also being profusely used in your derivatives curriculum as well. Definitely not part of the quantitative methods. But since it's again given, I'm required to walk you through this. All right, so let's visualize the problem, what's being stated. And we have the two countries to create a nation, the US and India, my country. And you have the current exchange rate, dollar versus INR at 100, which is known as, this is the spot interest rate. This is the spot interest rate. Now, what's also being told is that the risk-free treasury rates at both US and India are 4% and 6% respectively. So let's just simply denote them as RF, risk-free rate of interest in US is 4%, while that of India happens to be 6%. Now, that being said, let's think of a situation that you are to visit, let's say, US in the next year, and you want to actually uh, obviously you'll be carrying certain dollar, and you want to carry the you want to buy those dollar. Now you have a couple of options. You could buy those dollars today, but if you buy those dollars today, of course, the Indian regulation would require you to state the purpose, and they're very strict about it because it's a capital outflow that's happening from the currency of reserve. So they're obviously going to ask you the very purpose, and the very purpose, if it happens to be your immediate travel or any foreign exchange, you could have several commitments. I mean, or importing, immediate travel, your student education, etc., medical emergency, so on and so forth. I'm not getting into the details. Just that you could do this. If you were to do this today, obviously you will have to buy the dollar at 100 rupees. This is what is known as the spot exchange rate. Now, a year down the line, the rate which will be prevalent is what is known as the forward rate. Forward rate. Now, this forward rate again needs to be rather arbitrage free. That means nobody should be having free lunch because of certain exchange rate differential or certain interest rate differential. How is it so? So let's just arbitrarily pick up. That 1 year down the line, the spot interest rates of the USD versus INR happens to be 110. So what has happened? Of course, the rupee has depreciated further by 10%, and dollar, of course, has appreciated. It's no rocket science for us to understand. Now, given this scenario, of course, can we exploit this opportunity? If somebody had the notion that, well, a year down the line, indeed, the rupee is going to depreciate further from the current spot rate of 100 to 110, and the prevalent interest rate is going to be 4%, and 6% out here, then of course there makes a certain sense to lock in a forward rate, isn't it? How is it so? Because think of it, if there are no trade barriers, there are no restrictions, and the capital mobilization from one country to another is completely seamless, that means that there are no artificial barriers for a global trader. It's as good as actually saying that you're doing a domestic trade, albeit with different currencies. All right. So that means that I could borrow at the rate of 4% out here. I could borrow at the rate of 6% out here. I could invest at the rate of 4% out here, and I could invest at the rate of 6% out here. Okay. Now we could figure out both the scenarios, and let's see. For example, let's just assume that I borrow $100. I borrow $100 from the US market. And I decide that since 6% rate of interest seems to be more lucrative, why not invest this? Because if I have to borrow from the US dollar, then of course, at the end of the year, I'll have to pay 4% plus the principal that I borrowed, which will tally it to $104. But if I invest out here, let's see what happens. If I do invest out here, this $100, first and foremost, I cannot invest in dollar in India. I'll have to first convert this into domestic currency. On the spot market that would mean $100 would mean 10,000 Indian rupees. 10,000 Indian rupees. Okay. So 10,000 Indian rupees, if you invest at the risk-free rate of interest at the end of 1 year, you're going to get 10,600 as part of your entire yield. Now, if you want to repatriate back this to the US, you will have to do that because you'll have to meet your loan obligation. That would mean you'll have to convert this into the then spot interest, the spot exchange rate prevailing in the market. And what did we say? We are imagining certain hypothetical scenarios. One of them being that what if it is 110%, 110 rupee per dollar? So if it is so, that means I'll have to convert this 10,600 rupees first into dollar. And if I have to do it, all that I have to do is to divide this by 110. So if you divide this by 110, that is going to yield you $96.36. $96.36. That means you will only be able to take home $96.36 out of this, which clearly tells you that this is a loss-making business that you did, and you in fact lost around 7.64 US dollar for every $100 of trade out here. Not a good proposition, right? Why is it so? Well, you could understand that because the spot interest rate out here is not favorable. Okay, but let's reverse the whole scenario. Let's assume that indeed your anticipation is 110, And let's also understand that indeed it is 110 1 year down the line. What if I do the reverse thing? That means I borrow from India and invest in US. Could I do that? Yes, I could do that. I could do that, right? So how do I do? All right. So the way I will be doing is I will be borrowing 100 rupees, let's say 10,000 rupees. 10,000 rupees makes more sense from here. And if I borrow at the rate of 6%, of course, I will be required to pay back return with interest 10,600 rupees 1 year down the line. This is my liability obligation, right? But this 10,000 rupees, when I convert this into US dollar out here, it's obviously going to yield me 104 when I invest into the risk-free security. Now comes the big part. And the big part is that 1 year down the line, since I'll have to repatriate this back to India, I will have to convert this into the Indian domestic currency. And at that particular prevailing rate of exchange, which happens to be 110, which means that the yield in Indian currency of $104 is exactly equal to 11,440 rupees. Okay, which means that with this trade now, I have made a clean sweep. With this trade now, I have made a clean sweep of 840 Indian rupees. Isn't this great? For every 10,000 such dollar that I borrow, I make a riskless profit because these are governments, these are sovereigns, so the chances of default is zero, next to impossible. And this is completely a riskless trade, which has actually earned me now 840, right? Riskless. Now imagine if this were the scenario, we are effectively talking about free lunch. Since you already have now got the hang of how it looks like, it's not very easy, and I'm not going to get into the mathematics of it, but of course, it's not a challenge to understand that what would happen if the spot interest rate 1 year down the line is anticipated to be, instead of 110, instead of 100, let's say it becomes 95. Because if it does become 95, then the reverse will become true. That means at that particular point in time, investing in India would yield you much higher profit than what it would be in the US. Reverse is going to be the case. Okay. Not only because that you've got a 6%, you've got a differential yield which is higher in India, but because by the end of 1 year, the Indian rupee would have appreciated with respect to the dollar. Okay. So we could understand that studying these two examples, that neither of these are actually desirable from the long-term perspective of trade um, relationship between the two countries. Of course, I'm not talking about the current tariff regime or the whatever uncertainty which we are in. But all that I'm saying is that there needs to be certain consistency, certain sanctity to this whole relationship, so that the arbitrage opportunity cannot be exploited, because it's not going to be beneficial from any of the countries' point of view, right? So that means that the forward exchange rate, when we are talking about the forward exchange rate, uh, forward exchange rate, exchange rate, forward exchange rate, or let's just simply call it the FX rate. So the FX rate will have to have certain anchoring, and that anchoring is towards not only the spot interest rates of today, right? Not only the spot interest rate of today, but also will have bearing to the interest rates that is prevailing in India, as well as interest rate that is prevailing in the US, such that nobody should be able to encash the differential in such a way that would yield an arbitrage, riskless arbitrage profit. Okay, so that means there must exist a relationship between these three, isn't it? In other words, if I take a dollar one out here, if this $1 is being taken today and this $1 is being invested into the domestic currency itself, which is going to yield 4%, that is 1.04. This must be equal to somebody who takes the same $1, okay, same $1, and invests in India and earns 6%. The only difference is that this is the spot rate today. This is $1 today, which we are investing and which is going to yield you 1.04, because we are talking about $1. You could multiply this with $100, with $100 million, a billion, or $1 trillion. I could care less, but the equation would remain same. So if somebody, an investor, invests in the US market in the spot by taking $1 and investing at 4%, and the same investor or a similar investor taking that dollar and investing into the Indian market, and then investing in the Indian market, which is going to yield 1.06. But this 1.06 will have to be converted into dollar for this equality, right? Because we cannot directly equate dollar equal to rupee. That does not happen. So let's say that we talk this, that the foreign exchange rate 1 year from now, we're going to denote this as FX. So that means that these two must be equal. All that I'm saying is that this equation must hold, isn't it? Because if you look at any other way, if there be any exception, arbitrage will actually set in. So in other words, we can always find out what is going to be the FX rate, okay? And the FX rate out here is simply going to be equal to 1.06 divided by 1.04, or equal to into 100, yeah, which is equal to, I'm sorry, uh, so a little bit of, so the FX is going to be equal to 1.06 divided by 1.04. And this is from the rupees perspective, you must understand, okay? So again, I made the silly mistake I'm making. All right. So FX is going to be 1.04. I simply did the algebraic transposition out here. So this becomes 1.04 divided by 1.06. All right. So this becomes 0.98113, 0.98113 of what? 0.98113 of what? Yes, now that's the question. You see, what did we say? An investor who could freely invest into the US market $1, or the same investor could freely invest into the Indian market $1, of course, suitably exchanged, and earn 6% yield out of that. What the forex rate from the Indian perspective point of view 1 year down the line would be, right? So it's understood that the same 100 rupee, which used to fetch $1, because that was the spot rate, right? That was the spot rate. The spot rate was how much? $100. So the same $100, so the same 100 rupee which used to get us $1 now is only going to get us $0.98, $0.98113, and not even a one full dollar. You could do the reverse as well. Simply putting in FX into 1.04. Mind you, this FX happens to be the forward rate, not the spot rate, okay? Is equal to out here as 100, because it's 100 rupee for every dollar, right? Into 1.06, okay? And this FX will now become 100 into 1.06 divided by 1.04. So this becomes 100, this becomes 101.92. Okay. So what does this mean? It means that for every $1, it will now become 101.92 Indian rupee 1 year down the line. And if you look at this, these two are exact reciprocal of each other. Now I know that even at this point in time, it may sound a little confusing, it may sound a little overwhelming, and that's absolutely fine. Don't break your head too much into this as of now, because we're going to anyway cover this when we study economics, when we study the forward exchange rate in our currency hedging and in derivatives as well as in fixed income as well. For now, suffice to say that all that you need to understand, that all other things remaining constant, the country bearing the higher interest rate, higher nominal interest rate, is going to lose its currency value as compared to the one that has a lower interest rate. And traditionally, since India's interest rate is more than that of the US, obviously it's a gradual declining path only for the Indian rupee going forward. All right. Because if you look at any other way, it's only going to yield you an arbitrage opportunity. So now that we have got a sizable background, let's now understand the question. A forex dealer is quoting a 1 year forward rate of USD 1 at 104. So obviously you can understand if that is so, you should then sell this forward contract. Why you should sell this forward contract? Because for one simple reason, that the justified forward rate 1 year down the line, we have calculated to be 101.92. We could equate this to about 102 roughly for our calculation purposes. If anything is selling higher than that, obviously that's overpriced and we must sell. The basic rule of arbitrage is to sell where the price is high, buy where the price is low. Dealer number 2 is quoting 1 year forward rate 101. Obviously, you must buy, because if you buy 1 year down the line, you're going to pocket about rupee 1 for every $1 transaction, right? And the dealer number 3 is quoting a 1 year forward rate at the exact justified rate of 101.95, or roughly 102. Here, you're not going to make any profit. You're not going to make any loss either, okay, by either buying or selling this. So this is how the no interest arbitrage exchange rates are being set between two countries. All right. Now, as before, the option pricing, as I've stated, I'm not going to cover here because that would require a great deal of understanding about derivatives, about the different pricing models of derivatives, about the relationship between the derivative and its underlying, what is meant by hedge ratio and stuff like that. And that's being covered, that's being fleetingly mentioned in your quant curriculum. which obviously does not make any sense whatsoever. So I have left this portion for the derivatives section only when we study them. So we now boil down to the concept checker. Then I read the first problem. The value in 6 years of 75,000 invested today at a stated annual rate interest of 7% compounded quarterly. So how many quarters are there? 6 into 4, there is going to be 24 quarters. Okay, the rest of the things are easy. And the 7% interest rate, obviously you will have to divide this by 4. You could do this way, or there is one more way which we could do this, wherein you could make use of your calculator, as we have stated before, and converts this 7% quarterly compounding to the effective annualized rate. So all that you have to do is to press second, press then the the icon for button, and feed in the data, the nominal interest rate being 7%, the compounding frequency being 4. You will have to ask your calculator to give you the effective interest rate or annualized effective interest rate. And if you do so, I believe you're going to get something around 7.25%. So you could do it in two ways. Either you could say $75,000, which has been given, into 1 plus 7% divided by 4 whole to the power 24. You could do this way, or you could do this 75,000 US dollar into 1 plus 7.25%, which is the effective annualized interest rate, to the power 6 out here. Either of this is going to yield you, I think, a value of 113.733. Next question. For a lump sum investment of yen 250,000 invested at an annual rate of 3% compounded daily, the number of months required for the investment to grow to a given amount is close to how much? Again, FV has been given as, I'm discarding the last 3 zeros from each of them just to make it a little simpler. That's all, because this is in yen. So FV have been given as 1,000. Then 3% compounded daily. And as before, there are two ways of doing it. Either you could annualize them. You could annualize the 3% daily compounded to annualize. I'm sure that you could use the same interest rate conversion function in your calculator, by suitably keying in the value, right? So 3% is your given interest rate compounded daily. So C by Y will become 365. And then you will have to ask your calculator to give you the effective annualized interest rate for 3% for a 365 days compounding. And it's going to obviously yield you some 3% plus value. It's going to be more than 3% plus. And I believe that if you've gotten this, then the rest of the thing is again easy, because you have annualized now. You could directly make use of the year function itself. It's now going to give you the year function. Okay. Uh, use the year function, wherein PMT is equal to 0, then you have got the effective interest rate. That's something 3% plus is going to be. I'm not doing the calculation. I expect that you would be able to do it yourself. All that is required is the present value right now happens to be 250 negative, and we have to find out the number of periods. The number of periods out here, since you have annualized, please understand, we're going to get them in years. So if you have to compute, if you have to convert them into months, you'll have to multiply them with 12. And I believe that the answer should be 577 or 576 months. I'll leave the calculation to you. The next question says, a saver deposits the following amounts in an account paying a stated annual rate of 4%, compounded semi-annually. Okay. At the end of 4 years, the value of the account is close to. Now, this is a fine sum to work with. So there are 4 investments being made. The first year, 4,000. Second year, 8,000, 7,000, and 10,000. At the end of 4 years, what is going to be the yield to this account? Well, in the compounding frequency, as has been stated, quarter one, quarter two, we need quarter three and quarter four. This is a quarterly compounding. Okay. And the tenor is for quarterly compounding. And the tenor is for 4 years. Okay. This is what it says. So how do we go about this? Now, this should be easy. This is not. Oh, sorry. I'm sorry. It's not quarterly compounding. It's semi-annually compounding. I'm sorry about this. Yeah, it's semi-annual compounding at 4% interest rate. So how do we do it? So again, the best way of actually doing this is first to convert this into the effective annualized rate. Okay, so in order to do so, what do we have to do? We have to use the second icon function button we have to press, and then we come to the interest rate regime conversion worksheet. So nominal is 4%. Press the down key and let me work alongside you. So it's 4%. Then you press the down key, you're going to get the effective, but this is what we have set out to find. So we leave it as it is, press the down key once again, and we come to the compounding frequency of 2. And once we got the compounding frequency as 2, you can press the up key once, where you'll come to the CPT, and now press the CPT button, and your effective annualized interest rate is going to be 4.04%. Okay, so now you see how we have simplified the problem. Now we are no longer bothered by the semi-annual compounding of the different cash flows that's being actually stated out here. Now we have got different cash flows, but these different cash flows are now being annually compounded at 4.04% each. And all that we have to find out is what is going to be the yield at the end of the tenor. So for this, since these cash flows are uneven, I'm going to make use of the cash flow function. Now, all that I'm going to do is open the cash flow function, press CF. It's going to by default show you 0. If it is not, then obviously clear your worksheet by pressing second and CEC so that none of the remnant memory remains. And your worksheet is absolutely fine and memoryless, fresh. Press the down key and you're going to default to C01, key in the value of 4,000. Press the down key again, ignore the F01, which is the frequency. C02, feed in. C02, feed in 8,000. Then C3, feed in 7,000. And C4, feed in 10,000. Now we have got all of them. I want you to press the NPV button. Once you come to the NPV button, by default, it is going to show you the interest rate. If there be no other value, fair enough. If there is any other value, ignore that and put the value of 4.04, which is the effective interest rate which you found out, right? And press the button enter. So press 4.04 and press the button enter so that you feed in the value of I as 4.04%. Now, if you press the down key, you're going to come to the NPV function. And once you come to the NPV function, I want you to press the CPT button, the compute button, and your calculator is going to throw you certain value of 25,986.14. But this is not what we had set to find out for. I'll show you later that this is also related to how this can also be made use of to calculate the final value, but that's not important here right now. I want you to press the down key. Once you press the down key once again, and you're going to get NFV, which is the net future value. So the net future value, or NFV button, when you come to, just press the CPT button and see the magic. Press the CPT button, and it is going to throw you a value of 3446.90, roughly 3447. Okay, this is the net future value. So how it looks like, let me just show you that we have got 4 years, right? And different cash flows happening out here. This is C1, this is C2, this is C3, and then this is C4. Okay, now in this case, what's happening is these are all semi-annually compounded. With the semi-annually compounded, what's going to be the final yield out here? That's the question that has been asked. And we calculated this by first converting the given interest rate semi-annual regime to the effective interest rate annual regime, annual compounded, and then thereafter keyed in all the values to find out the NFV. We also found out the value of the NPV, that is the net present value, and the net present value is basically the value out here, 925,986.14. Now, I want you to do a small experiment. You could take this 1.04, this 4.04%, that is, and compound this 25,986.4 for 4 years and see the result for yourself. It's exactly going to yield you the result of 3447. All right. So this is identical. So the reason for me to walk you through this, that if NPV is suitably compounded for the given interest rate for the given tenor, will default to the net future value. Conversely, if the net future value is suitably discounted, then it is going to default to the NPV. That's the relationship between the two. All right, so let's now come to the next problem, and it reads, grandparents are funding a newborn's future university tuition cost estimated at $50,000 a year for 4 years. 4 years with the first payment due as lump sum in 18 years, assuming a 6% effective annualized rate, the required deposit today. All right. So we need to understand here what's happening. So we have got time t is equal to 0, and then time t is equal to 18. But after here, there are 4 more years to be precise. Okay. And each one of them will require an estimated 50,000 US dollar as part of the tuition fees. Okay, so the grandparents want to fund this newborn's college education at that particular point in time. At the 6% effective annualized interest rate, what should be the lump sum deposit out today? That's the question that's being asked. So first and foremost, we have to PV the entire cash outflow of 50,000 per year for the next 4 years. And that's pretty easy at 6% rate of interest. To find that out, what do we have to do? We have to make use of our TVM worksheet. And you know how to do it: second clear TVM, second FV. And now what we're going to do is first put 50,000 as a PMT, that is the annual cash outflow to the college. And this has to continue for 4 periods. So N is equal to 4. The effective rate of interest has been given as 6. So we put I by Y as effective rate of interest here. And of course, at the end of 4 years, there are no expectation, because that would have already exhausted the savings altogether. And now we have to find out the CPT PV. If we do that, so we'll find that the required yield out here has to be 173,255. 173,255. This is the required yield. Of course, this may precede with a negative sign. It depends upon how the PMT. If the PMT you're proceeding with negative sign, this is going to come positive. If your PMT is positive, then this is negative. That really doesn't make any difference as far as our understanding is concerned. But just to remember to distinguish always between cash inflows and outflows. All right. So now this 173,255 18 years down the line becomes the new future value for the deposit that is to be made today. For the deposit that is to be made today, this becomes the future value. So accordingly, then we can set this out. We could write 173,255 as our future value. N is equal to 18 now. 6 remains the interest rate. There are no interim payments, so 0 is PMT, and we have to find out the deposit that's required. So we press CPT and then we press PV, and the PV gives you a value of negative of 6698.81 something, which is roughly 6699. So this is the amount that the grandparents must deposit in some savings instrument that yields around 6% for the next 18 years in order to fund the tuition for the grandchild. Okay, and folks understand this is exactly how financial analysts work. In fact, your personal finance analyst actually, you should at least, even the beauty is that if you leave aside the CFA exam altogether as well, these learnings are your practical learnings. They are going to be handy as far as your own personal finances are concerned. Given the timeline, the next question is, given the following timeline and discount rate of 4%, year compounded annually, the present value as of the end of year 5 out here of the cash flow received at end year 20 is closest to 2. So this is the amount that has to be closest. We've got a 15 years timeline out here. All that we need to do is to consider this n as equal to 15, n as equal to 15. N as equal to 15. And I by y is 4%. PMT is 0. FV is 50,000, of course. We have to find out the CPT. I think you can do this job. I don't have to actually get into it. Let's now boil down to some of the CFA problems, AOC problems. Grupo Ignacia issued a 10-year corporate bond 2 years ago. The bond pays an annualized coupon, 10-year corporate bonds 2 years ago. The bond pays an annual coupon of 10.7 on a semi-annual basis, and the current max yield to maturity, that is the discount rate, we are going to consider the single discount rate of 11.6%. We have to find out the current price of this bond. All right, so let's first visualize the whole thing. We are talking about 10-year period. This is where the bond was actually issued. So this is actually not t is equal to 0, but ideally speaking, just a sec. Yeah, let's say this is t is equal to 0. No, this is not t is, no, this is not t is equal to 0. This will be wrong if we say t is equal to 0. All right, so this is the whole scenario now. Okay. So now what we have, We have n as equal to 8 into 2, 16 periods. Okay, we have 16 periods out here. Because it's paying a semi-annual coupon. The coupon that is being paid is equal to 5.35 for every $100 because it's a semi-annual coupon. So this happens to be 5.35. Okay. The face value by default of any bond we assume to be 100%. The yield to maturity, which we are going to denote as the discount rate, happens to be 11.6% annualized. So which is basically 5.8%. This is 5.8%, if I'm not mistaken. Yes, it's 5.8%, correct? So given this four details, we have to find out the CPT present value. So let's just feed in the data accordingly. Oops. You get a value of 95.39. So the next question reads, Grapable Real Estate seeks fully amortizing fixed rate 5-year mortgage loan to finance 75% of the purchase price of the residential building that costs around 5 million. Annual mortgage rate is 4.8%. Monthly payment is required. I think that again, this is damn easy. So we have got N is equal to 5-year mortgage monthly payment. So N is equal to 60 months since monthly spread. The loan that is to be taken out is going to be equal to 0.75 into 5 million, which is equal to 3.5 million, of course, in New Zealand dollar. And the interest rate is equal to, of course, 4.8 divided by 12 because it's monthly. It's around 0.4% per month. Let's not forget this, 0.4% per month. Okay. At the end of the tenor, of course, the loan is required. So the future value happens to be 0. Given all this, we have to find out the level payment to be made. I'm sure that you could do this. You don't require my help. The next question reads that Malandia Corporation pays an annual dividend to its shareholders, and its most recent payment was CAD 2.4. Analysts following Malandia expects the company's dividend to grow at a constant rate of 3% per year in perpetuity. Shareholder requires a return of 8%, the expected share price. So whenever you have this, so how do we do this? So the P0 is equal to the recent payment was 2.50. Mind you, whenever it is said recent payment, past payment, payment yesterday, all those are to be considered dividend as the D0 and not a dividend forward. Okay, so this is something that you need to distinguish always. And whenever you're talked about being expected payment, so those are basically dividend forwards. And the dividend forwards is always equal to the D0 is always equal to the past dividend that's being paid multiplied suitably with the growth rate. So out here, the dividend that was paid was 2.40. and the growth in perpetuity is deemed to be 3%, and the required rate of return is 8%. The growth is 3%. So if you, that's all that is required for you to solve this problem. So it is 2.4 into 1.03. This divided by 0.05, which equals to 49.44, and P is your answer. Grupo Ignacio issued 10-year corporate bonds 4 years ago. Bond pays 4 years ago. That means 6 years are remaining. Bond pays an annual coupon of 10.7. Semi-annual basis current price is this. Value of the YTM. I'm sure that you could find this out. There's no need for me to actually work through this anymore. This is T is equal to 0. This is obviously T minus 4. This is T is equal to 10. That gives us the total intervening period of 6 years. The bond pays semi-annual coupon, so N is obviously going to be 6 into 12, 6 into 2, 12 periods. Current price of the bond has been given. As you know that in case of TVM worksheet, out of the 5, if 4 variables are given, the 5th variable can always be found out. So the PV has been given to be, always remember to change the sign between these two, okay? The PMT is being given as 5.35. PMT has been given to 5.34. So 1, 2, 3, 4. 4 variables are being given. We have to find out the yield of the bond. You could do it yourself. I don't think I need to work on this. The next question reads, how many are there? Okay, this is the last one. Great. So an analyst observes the benchmark Indian Nifty 50 stock index trading at a forward price to earning ratio of 15. Always do remember, as I said before, unless otherwise mentioned, it is always P0 by E1. That's being stated to be 15. The index expected dividend payout ratio in the next year is 50%. So that means that D1 is equal to E1 into 0.5. This already been mentioned. And the index required rate of return, that is R, is equal to 7.5%. And the growth rate is deemed to be 4.5% forever. Which of the following statement is correct? It is overpriced, underpriced, or fairly priced. So let's understand first, so you know the relationship between the D1 divided by R minus D. Sometimes R is also stated as K. It doesn't matter. Where D1 can be expressed as E1 into the X percentage payout. In this case, it is 50%, right? I'm sorry. P0 is equal to D1 by Hans is P1. So this is equal to R minus G, which tells us that if we use this P0 by E1 out here, this will become 0.5 divided by R happens to be 7.5, and this happens to be 4.5. So if you do this, it's going to come out to be somewhere around, I believe, 16.6%. I think 16.7, 16.67, if I'm not mistaken. Let's just work it out once. Yes, it's going to be around 16.67. 16.67. All right, so now we'll have to do. So what does it mean is that for every dollar earned, every rupee earning in Nifty, the Nifty should be fairly priced at 16 rupees 6.67. It should be priced. But instead, what we see is that for every earning that Nifty is generating, it is priced at only 15. That means Nifty is selling cheap, Nifty is underpriced. And you should obviously buy this security. All right, so I hope that through this extensive part 2 presentation, all our concepts, but for that option pricing, which I have deliberately kept away from this particular chapter, are thoroughly clear. I have solved more than 50% of the EOC problems as well. I have taken few of the exceptional problems which are not even covered in your CFA in order to drive home the point. If you have followed through the parts of the presentation, both part one and part two, I'm sure the TVM problems, the time value of money in finance problems, should be amply clear. Do not forget to practice the problems. Stay tuned for the next lecture. Thank you so much.